Thought I'd kick off with not a stock of the day, a bit of a sector of the day, the banking sector. As Aussie banks are expected to experience an average 10% decrease in their cash profit before significant items during the first half of, or the September half compared to the previous year. That's according to Morgan Stanley. Now, the brokerage firm anticipates that the pre-provision profit of the three major banks reporting their second half results in November will decrease by an average 9%. It's attributed to a 2% reduction in revenue, 3% increase in expenses. Morgan Stanley's banking sector analyst Richard Wiles suggests that while the potential for a soft economic landing in Australia and healthy balance sheets provides some protection against the downside risks, the industry continues to face challenging conditions. Growth prospects are weak, profitability on the decline. So Scott Phillips from Motley, does that mean you avoid the banks altogether?
Mate, I don't think it needs to without then asking about the price. We haven't seen, or there isn't necessarily a view from Morgan Stanley about therefore what price you pay for these banks, because I think it's a really good opportunity to remember these are cyclical businesses. It's been so long since we had a proper economic cycle. The last fair income recession was the early 90s. Of course, COVID was bad, but super short and massively supported by government stimulus. And so if you think about going back to those early 90s when Westpac and ANZ got themselves in a bit of trouble, we need to remember these are cyclical banks. They are exposed to the broader economic cycle, the housing market in particular. So I don't think there should be any surprise that if we do end up in tougher circumstances, that profits growth will be hard to come by. They've made their fortunes on the back of higher business and mortgage lending. There's probably no surprise that that is going to moderate, maybe even fall from time to time. So no, it doesn't mean you shouldn't buy the banks. What it means is you should really understand one of my favorite three-word phrases these days is underlying earnings power. That is not just from peak earnings, not just when the times have been good to great, as in the last few years for the banks, but over the cycle. What are we likely to see? Are we paying a decent price for that? And that's where I'd be focusing, is not, are they worth buying? I don't think any of the big four are going to get into serious trouble. No guarantees, but I don't think it's likely. That said, if profits are meaningfully lower or profit growth is harder to come by, you don't want to be paying extraordinary prices for some of these banks.
Okay. Are they extraordinary prices at the moment? Because the big banks are the darlings of retail investors. Usually they're overweight them and they think they're just going to keep going up and have fantastic dividend returns. Is it a time to really be realistic and reduce your exposure to the big banks? Should you be in them altogether? Any of it?
Yeah, so I own no big banks. I own no big banks at all. You don't have to own the banks. That being said, plenty of people have got spectacular capital gains from owning them for 10, 20, 30, 40 years and doing very nicely. So I wouldn't, just because I don't own them doesn't mean other people shouldn't. I think your first question, Koshi, is the really, really important one, is how is your exposure? Check your exposure to banks. Owning all four banks is not diversification. And so if you've got, in some cases, there are some numbers I saw maybe 18 months ago, some people have upwards of 2/3 of their portfolio represented by the big four banks. Right. That is way too much risk. Not necessarily in terms of absolute failure. Again, I don't think any of them are going to fail, no guarantees, but I don't think it's going to happen. But if they were to stagnate or even fall, and potentially fall meaningfully or maybe just stagnate for a while, I think it's still true that three of the big four banks are actually still down on the share price of 5 years ago. I think that's true. I'd have to check that. I haven't prepared those numbers today. But to the extent that's true, if you've probably made a lot of money with them, it's so tempting to say, I made all this money, they're great businesses, I'm going to keep holding them. I get that thinking. But yeah, really, really consider your portfolio weighted to any businesses, but in particular the banks, and in particular if you're way overweight them, I think it is time to maybe reassess.
Josh, what's your view on the sector? Is Morgan Stanley putting up the red flag on banks?
Oh, I think they're just in for another year of sort of stagnant movements. So, like Scott reiterated, they've done not a lot, or three of them have done not a lot, and I think they're in for another year of that. There's a few risks, I guess, to their short-term earnings. So we've seen the net interest margins across the board increase. I think CBA is the best at the moment, so that's at about 2.1. but the average for the big four banks is about 1.8. So they haven't experienced such a big uptick in net interest margins and the NIM, as I guess the cash rate movements have been probably a bit too aggressive for them to, really capitalise on that. And we're starting to see a lot of mortgage stress news come through. I think it was a pretty large portion, depending on which market you take. About a third of households that have a mortgage are in that mortgage stress category, which is paying about more than 30% of their income to their mortgage. So we haven't seen the delinquency rates really tick up just yet. Very marginally. It's very low in the US. Their average is like 2.5% in sort of delinquency rates, and it's at 0.5% at the moment. But definitely something to keep an eye on. Here in Australia, it's 0.75%. So something to keep an eye on if people are struggling to make back those repayments. Again, we sort of saw through COVID that the banks have solutions for those that can help people but probably benefit the bank in the long term. So I think that will probably occur again over the next year. They'll have a small hit to their revenues and therefore their profits, but obviously, increase their debt.
So are you in the banks at all at the moment?
We prefer CBA, however, we did do some trimming on that when we were getting quite bearish on the market. It's pretty much mid-range, it's at 90, sort of in this market where trying to buy these quality companies at year lows and sell them at highs. We're not in a breakout market, as the last couple of weeks have really proven to us yet again. So we'll just continue to take profits in these companies when they're at their yearly highs, and potentially buy when they're at their yearly lows, which there's a few of. CBA hasn't gotten particularly cheap. That's our preferred name, based on just pretty much track record of capital returns. So CBA would be.
So do your clients have big positions in the retail banks?
Look, we've worked pretty hard over the last couple of years to make it less of an impact and providing alternatives. Being overweight commodities and energy names. So,
I know you can't generalise, but an average investor with a portfolio, if they wanted to be in the banks, what should your weighting be?
I think anything over...
I know everyone's different, but just a rule of
I think
thumb.
anything over 20% in those four companies is getting to the extreme end. Right. Generally, we don't like to have more than 10% in any one company, so there's a couple of factors there, and we'd usually reserve the right for the 10% allocations for these big banks, but more so when they're paying sort of that double-digit yield, which is not at the moment.
All right. Okay, let's start to good discussion now. I thought it was good to bring that up because I know so many of you are big into the retail banks. Morgan Stanley just flagging that at the moment. And the advice from both Scott and Josh is just make sure your portfolio is aligned and not terribly overweight these banks, because you're going to miss out on opportunities elsewhere. Let's get to